Tesla isn't just a car company, it's a cultural and financial phenomenon. Whether you love Elon Musk or can't stand him, there's no denying Tesla stock has been one of the most talked about and volatile assets of the past decade. But while the media hypes up the drama and retail traders chase headlines, smart investors are quietly making calculated moves in 2025 that could define their portfolios for years to come. In this video, we're diving deep into what those savvy investors are really doing with Tesla stock right now and how you can take a page from their playbook. 1. Understanding Tesla's current valuation. Let's start with the basics. What's Tesla worth in 2025? As of this year, Tesla's valuation has experienced some roller coaster moments. After a series of production bottlenecks, regulatory challenges, and leadership controversies in 2023 and 2024, many retail investors panicked. But smart investors, they dug deeper. They analyzed Tesla's revenue growth, adjusted for one-time expenses, and compared it to its forward price to earnings, PE ratio. While many still believe Tesla is overvalued compared to traditional automakers, smart money sees Tesla as a tech and infrastructure play, not just an EV company. They're evaluating it like they would Apple or Nvidia, not GM. 2. Watching the energy and AI expansion. Closely, Tesla Energy and Tesla's AI division are no longer side hustles. Smart investors in 2025 are particularly excited about the company's solar roofing, Megapack battery deployments, and Dojo, Tesla's supercomputer platform powering full self-driving. While most headlines still focus on Cybertruck delays or delivery numbers, these investors are accumulating shares in quiet periods, understanding that Tesla's long-term moat may come from energy storage and software licensing. They're betting that if Tesla succeeds in licensing its AI-driving software to other automakers, its revenue model becomes exponentially more scalable. 3. Dollar cost averaging. During dips. Rather than timing the market, seasoned investors are taking advantage of Tesla's high volatility by dollar cost averaging. This means they're investing fixed amounts on a regular basis, weekly, bi-weekly, or monthly, regardless of Tesla's stock price. This reduces emotional decision-making and takes advantage of short-term dips. Tesla dropped over 15% in Q1 2025 after a disappointing quarterly earnings call. Instead of panic selling, long-term investors increased their holdings. Why? Because volatility is not always a sign of danger. Sometimes it's an opportunity. 4. Using options strategically. While risky for the average retail investor, smart investors in 2025 are using covered calls and cash-secured puts to generate income on their Tesla positions. Covered calls allow them to earn a premium while agreeing to sell their Tesla shares at a higher price. Cash-secured puts allow them to buy Tesla at a discount while getting paid up front. These aren't speculative YOLO options trades. Instead, they're controlled, income-generating strategies rooted in risk management. It's a game of chess, not checkers. 5. Paying attention to Tesla's margins. Profit margins are one of the most critical metrics in 2025. Smart investors are carefully watching Tesla's ability to maintain healthy automotive gross margins in the face of growing competition from BYD, Rivian, and legacy brands like Ford and VW. Tesla's aggressive pricing cuts in 2023 and 2024 compressed margins, but increased volume. Now the question is, can Tesla increase margins again with efficiencies from Dojo, reduced raw material costs, and vertical integration? Smart investors know this will be key to sustaining its stock price long term. 6. Diversifying, not over-leveraging. It's tempting to go all in on Tesla, especially for younger investors who've seen massive gains over the last decade. But in 2025, experienced investors are hedging their Tesla exposure by balancing their portfolios. They may hold Tesla as their largest single stock position, but they pair it with ETFs like QQQ, VOO, or clean energy funds. Others may offset Tesla's volatility with dividend-paying stocks or bonds. The key principle here is risk-adjusted returns. They're not trying to beat the market every day. They're trying to win the long game. 7. Watching Elon's moves, but not obsessively, Elon Musk remains Tesla's most valuable and controversial asset. Every tweet, lawsuit, or venture into other businesses like XAI or SpaceX spin-offs can shake Tesla stock. Smart investors monitor Elon's decisions and distractions, but they don't react emotionally to every headline. They're looking at leadership stability, succession planning, and board governance. In 2025, Musk is still heavily involved, but there's increasing pressure for Tesla to operate more independently. Savvy investors are watching how well Tesla handles leadership depth and scalability beyond Musk's shadow. 8. Monitoring government policy and incentives. Government incentives still play a huge role in Tesla's valuation. From EV tax credits to clean energy subsidies, smart investors are following regulatory trends at the state and federal level. For instance, California's aggressive zero emissions mandates and Europe's carbon pricing schemes continue to benefit Tesla. However, changes in U.S. political leadership could shift the narrative. Smart investors are staying informed and factoring these macro risks into their positions, especially as Tesla expands into India and Southeast Asia. 9. Staying updated on competitor moves. Tesla doesn't operate in a vacuum. Smart investors are benchmarking Tesla's innovation pace against competitors like BYD, Lucid, Rivian, and even Apple's rumored entry into the EV space. They're not buying Tesla blindly. They're assessing whether the company still holds a technological lead. Key metrics include battery efficiency, autonomous driving milestones, and software updates. Investors are also watching China, where Tesla has both massive opportunity and massive geopolitical risk. It's a delicate dance, and they're managing exposure accordingly. 10. Playing the long game, with patience above all. The smartest investors in 2025 aren't chasing hype, they're practicing patience. Tesla is not a get-rich-quick scheme. It's a long-term bet on innovation, disruption, and global infrastructure transformation. These investors believe Tesla could be worth significantly more by 2030, but they're not betting the house. They're betting within their means, rebalancing when necessary, and keeping emotions in check. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Conclusion. So, what are smart investors really doing with Tesla stock in 2025? They're analyzing, not reacting. They're positioning themselves based on fundamentals, not headlines. They're diversifying, hedging, learning, and most importantly, thinking long term. If you're considering Tesla, don't just follow the noise, follow the strategy. Watch what the quiet investors are doing, not the loudest voices on social media. That's where the real money moves are being made. Please subscribe to New York City Finance.